Welcome to this Insider's Explainer. If you trade commodities, you already know the COT report, right? But today, we are pulling back the curtain on the most overlooked yet absolutely powerful category in that data to give you a real trader-to-trader edge. We are tracking the invisible giants of the gold market.
Here is our briefing plan for today. 1. We'll unmask the invisible giant. 2. We'll calculate the smart money index. 3. Spot the silent exit. 4. Build your institutional dashboard. And 5. Look at some historical case studies. All right, Section 1. The invisible giant. Let's look at who actually moves the gold market when literally nobody is watching.
So, the entire gold futures market breaks down into this 5-player ecosystem. Now, everyone obsessively tracks the managed money, the hedge funds, and the commercials. But they almost completely ignore the 4th row of the COT report, the Other Reportables. These guys aren't banks, they aren't miners, and they certainly aren't fast money speculators. They are the deep, patient capital sitting quietly right there in the shadows.
So who are they exactly? Well, contrast them with managed money. Hedge funds, as we know, are impatient. They're heavily leveraged momentum chasers who react to every 10% drawdown with a forced margin call. Other reportables, though, those are your pension funds, university endowments, and corporate treasuries. Their time horizon is measured in years, not days. Using zero or maybe very low leverage, a price drop is just a rebalancing opportunity for them. They slowly accumulate based on macro fundamentals.
Moving on to Section 2. Calculating the smart money index. It's time to track the giants.
To see who's truly in the driver's seat, we calculate the smart money index, or SMI. First, you find the raw smart-to-fast ratio by dividing the patient capital's net long position by the fast money's net long position. But because raw numbers kind of drift over time, step 3 is absolutely crucial. You got to normalize that ratio over a 3-year rolling window. Doing this creates a really clean 0 to 100 oscillator.
Once you've got that 0 to 100 number, map it out to these zones. An SMI below 20, that means heavily leveraged fast money is dominating relative to smart money. That is a massive warning sign that a sharp correction is looming, simply because there's no patient capital there to absorb panic selling. But when that SMI crosses above 80, the smart money has quietly taken control, putting a massive structural bid right into the market.
Which brings us to Section 3, spotting the silent exit, or basically, how to dodge the trap.
We call this the silent exit. And let me tell you, as a trader, this is the single most dangerous phase in the gold market. The smart money is quietly cashing out. They're distributing their longs into a late-stage rally, literally handing the bag over to late-arriving speculators. And the real killer here is that this happens without any immediate downward impact on the price. The price still looks incredibly healthy, the media is aggressively bullish, but the structural foundation, it is crumbling underneath. So how do you protect yourself? Well, you need to look for 4 specific conditions happening all at exactly the same time. First, the institutional longs of the other reportables have to drop for at least 3 consecutive weeks. Second, the hedge funds are still actively buying. Third, open interest is stalling out, which just means ownership is transferring from smart to fast hands. And fourth, the price stubbornly refuses to drop. If you see this setup, tighten your stops immediately. The smart money is using the fast money as exit liquidity.
Now, conversely, we have the bullish divergence. This is the exact opposite. In this scenario, panic selling by the fast money is driving prices to lower and lower lows. Honestly, it feels like the sky is falling. But if you track the other reportables, the patient capital is quietly absorbing all that selling pressure. Their net long positioning is actually making higher lows. They are actively buying the dip while literally everyone else is panicking.
All right, Section 4, the Institutional Sentiment Dashboard. Let's build out your weekly model. We call this synthesized metric the Other Reportables Sentiment Index, or ORSI for short. It scores the smart money's behavior from a deeply bearish -2 to a strongly bullish +2. It basically weights 3 components. 40% comes from their 4-week trend. Are they buying or selling? 30% from the historical level. Are they at an extreme high or low? And the final 30% comes from that relative smart money index we just talked about. This single number tells you exactly what the invisible giants are thinking. Every single Friday, when the new COT report drops, this is the checklist you should be filling out. Track the raw net long, monitor the 4-week change, note their share of open interest, calculate your SMI, log your RSI score, and explicitly check if a silent exit is occurring. Make this your weekly routine, for sure, and you will anticipate major market turns weeks before the momentum chasers even realize what is happening.
Finally, Section 5, Historical Gold Case Studies. Let's look at the undeniable proof.
We're going to examine 3 massive structural shifts in the gold market over the last decade. In all 3 of these major events, the invisible giants left clear, undeniable footprints that our dashboard absolutely would have caught.
Let's rewind to December 2015. Gold bottomed out at $1,050 an ounce. The media narrative? Universally bearish. And hedge funds were completely washed out. But our smart money index was already flashing in the 80 to 100 zone. The patient capital had been executing extreme smart money accumulation for months before the massive multi-year rally even began. They hit the nail on the head and bought the blood in the streets perfectly.
Fast forward to August 2020, and we have the exact opposite scenario. Gold hit a euphoric peak of $2,075. The media was practically throwing a parade, and hedge funds were all in, heavily leveraged long. It seriously looked like gold was going straight to the moon.
But here's the catch. Our ORSI dashboard had already turned negative a full month prior, back in July. While the fast money was enthusiastically buying the top, the smart money executed a textbook silent exit. They quietly distributed their positions, basically handing their expensive gold over to the hedge funds right before the inevitable crash. If you were tracking the other reportables, you locked in profits while everyone else got completely crushed.
And we saw it again incredibly clearly in late 2022. The Federal Reserve was aggressively hiking interest rates, and fast money was dumping gold in a total panic. But our OSI, it turned strongly bullish. The patient capital of endowments and pension funds quietly absorbed the selling. They perfectly positioned themselves for the eventual breakout that took gold well past $2,400 to new all-time highs. Once again, the slow money completely beat the fast money.
So, the absolutely crucial takeaway here is that your edge in trading commodities doesn't come from some magic technical indicator. It lies within understanding the market ecosystem itself. The COT report isn't just data, it's a living map of human behavior. So the next time you look at the gold market, ask yourself, whose footprints are you truly following? The panicked, leveraged, fast money, or the patient, invisible giants? Build your dashboard, track the other reportables, and trade with the smartest money in the room. Thanks for joining me on this explainer.